Today's episode of Hidden Forces is made possible by listeners like you. For more information about this week's episode or for easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you listen to the show on your Apple Podcast app, remember, you can give us a review. Each review helps more people find the show and join our amazing community. And with that, please enjoy this week's episode. What's up, everybody? My guest on this episode of Hidden Forces is Paul McNamara. Paul is an investment director at global asset manager GAM and serves as the company's lead manager on hedge fund, emerging market bond, and currency long-only strategies. My objectives with this episode have been twofold. Number one, I wanted to make sure that anyone, regardless of his or her background, would be able to follow the conversation and come away with a deeper appreciation and understanding of what emerging markets are, the forces driving performance in EM risk assets and currency, and how managers like Paul invest in these markets. My second objective was to make this conversation useful to people like Paul and others who are invested, looking to invest in, or for one reason or another are already somewhat familiar with emerging markets, their peculiarities, and the unique conditions which can make investing in these markets profitable for investors. The first half of our conversation focuses on the macro forces driving EM overall, things like how the latest vaccines could affect the global recovery and the service and export sectors in emerging markets, the global debt picture and its impact on economic recovery, the resumption of trade, and other such factors. The second half of our conversation focuses exclusively on one emerging market country in particular, and that's Turkey, a country that we've covered in depth on a number of previous episodes, most recently in my conversation with Soner Çaptay on episode 152. Turkey is a uniquely important country, not least because of its geostrategic positioning as a gateway between East and West, straddling multiple important theaters of conflict, diplomacy, and trade that matter greatly to all the major powers, including the United States. What happens to Turkey's economy, the country's ability to service its debts, and the value of its currency are materially important for its geopolitical stability and for the stability of its neighbors and NATO allies. To that effect, we examine some of the latest government family drama in Turkey, involving the president's son-in-law, Barut Ulbayrak, the significance of his ouster as Minister of Finance and Treasury, and its implications for the Turkish economy. We also discuss the recent 475 basis point rate hike by the Turkish Central Bank and what this means for the economy, domestic bank lending, and for the value of the lira going forward. Lastly, given the turmoil in relations between Turkey, the U.S., and Europe, it's an open question as to how an incoming Biden administration will deal with this important NATO ally, and if sanctions could be used against Ankara in the event that diplomatic headway isn't made and Turkey's president continues to go his own way on issues that are vital to both the U.S. and Europe. We had a limited amount of time available for today's recording, so rather than break this episode into two parts as I usually do, I recorded an afterthought segment that I've released on the Overtime feed for premium subscribers, with my take on the episode and general thoughts about what's been going on in the world and where I've been focusing my attention. The transcript and rundown are both available for this episode, and as usual, subscribers can access both of these either directly through this week's episode page at hiddenforces.io or through our Patreon page at patreon.com/hiddenforces. If any of you run into any trouble either signing up or finding the content for whatever reason, just shoot me an email at dk@hiddenforces.io and I'll make sure to get you all set up. Finally, it should go without saying that nothing we say on this podcast can or should be viewed as financial advice. All opinions expressed by me and my guests are solely our own opinions, and should not be relied upon as the basis for financial decisions. And with that, please enjoy this week's episode with my guest, Paul McNamara. Paul McNamara, welcome to Hidden Forces.
Thank you very much. Nice to be here.
It's great having you on, Paul. So for our listeners who are not familiar with emerging markets, and I would kind of include myself in that, I want to begin our conversation today with a sort of a summary of what they are. But before we do that, tell me a little bit about your background. Like, how did you get your start? What do you do? And I know you work at GAM. What is GAM and what is your role there?
Yeah, no, GAM, well, start at the end there. GAM is an investment manager, runs a variety of products. I'm in charge of the emerging markets debt effort. I've been doing emerging markets for 23 years now. My prior career, I left university and went to live and work in Poland for 3 years, picked up some practical experience of EM there, came back, went to work for the UK government covering emerging markets, and then just moved across to finance where I could do the same thing for a bit more money than I could in the civil service. It's been a time of huge changes in emerging markets since I started in 1997, and what we've been trying to do is just stay on top of all the things that are changing there.
Are you able to analyze an EM country strictly by the numbers without necessarily ever having visited? Or does it help to have a more on-the-grounds, intuitive understanding of the people, the culture, the politics, etc.?
Somewhere in between. I mean, finance comes down to numbers. Economics always comes down to numbers, how much of anything. It's always worth doing sort of proper country research, actually visiting it, meeting people. That's especially useful really to get more of a feel for what the numbers mean, what the shortcomings of the numbers are, what they might be missing out. But for me, investment makes sense if you're talking quantitatively. It has to come down to the numbers. And my instinct would always be very cautious around words like intuition or gut feel, which is, that's fine if you're betting on horses. But, when you're moving really large amounts of money and investing really large amounts of money, it does come down to the numbers.
The guest I just had on the program was Jim Chanos, and he said something similar, although he went a step further. He actually made the point that he actually avoids speaking with executives of the company, apparently, because his point is that it's very difficult if you're dealing in particular with a fraud. It's difficult not to believe someone if they're lying to your face. And so it's just a lot easier for him to look at the numbers, and it's actually saved him a lot of money, apparently.
Well, I mean, I never argue with an investor of his reputation. What we do is macro, which is a bit different. And I think it's a difference of emphasis rather than a difference absolutely. If you're relying on gut instinct, if you're relying on this whole kind of George W. Bush, I kind of looked into his eyes and I knew I could trust him, then you're going to get into trouble and you're going to lose money. The numbers are at the center of everything you do, but it's the nature of emerging markets, that you do get systematic problems with how the data is recorded, where the data comes from. And that's something that we really, that we kind of need to stay on top of.
So I've always wondered how one defines whether a country qualifies as an emerging market, because the definitions seem a bit squishy. I mean, it's almost like emerging markets are developing countries, but with prospects. How do you define an emerging market?
Well, we define an emerging market really in anything we're allowed to invest in, which is basically any country which is middle income or lower, according to the World Bank.
What is middle income? What qualifies as middle income?
I think it's about $15,000 GDP per capita at the moment. So what you're finding is, places a lot of people would think of as EM, like the Czech Republic, sort of don't really meet the criteria anymore or are starting not to meet the criteria. But there's also, I think the interesting one is a lot of the richer resource-intensive countries, places like the United Arab Emirates, Saudi Arabia, and so on, those have been reclassified, certainly by JP Morgan, who run one of the big indices for emerging market debt investment, as EM. And the reason for that is, institutional quality, that, once you classify a country as a developed market, the laws apply, the courts work, a contract can be relied on in court, whereas it tends to be a bit more basic in Saudi Arabia or somewhere. So basically it's poorer countries and countries with weak institutions.
But am I right to think that it is somewhat squishy? It's highly qualitative?
Highly quantitative, I think, is maybe a little bit strong. But yeah, no. I mean, there is definitely flexibility. The big division is between equity investors and debt investors. Equity investors will tend to go with MSCI. Bond investors will go with JP Morgan. And for example, there's a significant difference there.
So before we get into some of the individual countries, maybe you can just give me a sense of what EM countries you focus on at GAM.
Well, the countries that we focus on, because we're local currency debt investors, it tends to be the countries with a lot of debt in local currency, which kind of takes you out of the very bottom layer, because the poorest countries, places like Tajikistan, can't borrow significant amounts of money in domestic currency. They have to borrow in dollars. That's not really what we look at. And then once you kind of get up to the top end of emerging markets, the richest places, as I said, the Czech Republic, or the graduate countries, which I think 20 years ago would have been regarded as EM, now are not, places like Korea or Israel, because they're too low yielding. So it's sort of everything in between those two. So we tend, the big focuses tend to be the largest debt markets. So Brazil and Mexico, especially in Latin America, South Africa, Turkey, Poland, Russia, and Malaysia, Indonesia, India. Those countries, I think, account for the bulk of our efforts. They account for the bulk of the money we have invested. But, you have smaller places. You have places like Chile or Hungary, which also attract a significant amount of money. And you have to keep an eye on sort of frontier markets, places like Pakistan or Argentina, where the markets are smaller, they're less liquid, they're less developed, but they're still places where you have to be aware of developments and where we do periodically end up investing some money.
So that's actually one of the things I was curious about. First of all, many countries issue both domestic denominated bonds as well as dollar denominated bonds. So I wonder, is there a tipping point where there's a certain percentage that they issue? Why do you focus on local currency lending to countries and is it mainly, do you work mainly in terms of fixed income? Is that mainly how you guys invest?
Yeah, we're a fixed income
sovereign
investor,
bonds?
and local currency sovereign debt is what we specialize in. That's because the background of the firm is macro, so it's currencies and bonds rather than credit. It's just how we have come to the asset class that we look at currencies, we look at interest rates, we look at inflation much more than we look at debt ratios or fiscal balances or the quality of banking sectors.
That's also a more leveraged bet, right? Because you're
because it
taking
includes
on
the currency
risk.
investment.
Yeah.
Yes, absolutely.
Assuming you're not hedging the currency risk.
No, we're not hedging the currency risk, and a huge amount of the volatility around the asset class does come from the currencies. In a way, it's kind of a bridge between the hard currency debt and equity. It's not quite as funky as the equity, but the profits and losses can be significantly larger than just looking at, well, will this bond default or not?
So
aggregate.
How have emerging markets fared in 2020 relative to developed markets, and what state are they in heading into the new year?
Well, it's been a very interesting year. Obviously, with COVID, what you tend to find is that emerging markets are a play on global growth. And given that we've been enduring the biggest, most synchronized global recession in living memory, it's been, the initial period of the coronavirus crisis was horrendous in terms of how it affects emerging market debt. April, I think, was the worst month in the history of the asset class, as it was for many asset classes. At one point, the asset class had lost about 25% of its value. At this point, it's clawed nearly everything back that, once we got beyond the shock stage, because emerging markets generally haven't suffered as badly in terms of deaths as developed markets. That's got a lot to do with demographics. This is a disease that kills old people, and populations in EM are generally a lot younger than they are in the developed world. But it's been an absolute roller coaster. We had a horrendous crash in the second quarter, quite a sharp snap back. And we were treading water really until the US election. And then the double whammy of a return to a more globalized world order, where I think a Biden administration is seen as being more supportive of the World Trade Organization, and a rules-based global environment and foreign investment. But of course, a vaccine would suggest that we're going to be back in a world, or we could be back in a world that looks much more like the old normal, rather than, a lot of chatter we had a few months ago, oh, there's a new normal, we're never going back to the old way. So you can be much more optimistic about the growth outlook, and those two things have been very supportive for EM, and we've had another leg up through November.
So you touched on a number of things that I want to ask you about. First, in terms of the virus's impact on emerging markets, to your point about demographics, we have been told that their hospital systems are much more impaired. So that's an interesting point, that still the impact of the virus is much lower because the people are much younger. But developed markets have been impacted, and many of these emerging markets export to developed markets. So how has that played a role?
Well, that's actually been interesting, because what we found is that you've had a huge shock in both EM and DM as a result of the coronavirus. But what we've generally found is people in developed markets have found that the financial systems have held up better because of the experience of the global financial crisis in 2008. There's the mechanism of quantitative easing by which central banks, the Federal Reserve, the Bank of England, also the ECB and the Bank of Japan, buy government debt directly, and that provides a funding for a huge fiscal expansion. Whereas we found in emerging markets, people are much more skeptical about QE, that, there have been a couple of exceptions like Poland, but generally speaking, the central banks in emerging markets have not been buying government debt, and the fiscal expansions in most emerging markets have been much smaller than in DM, with the result that the recessions have actually been much worse in EM than they have been in DM. The compression in domestic demand has actually been bigger, because although the impact of the virus has been less, the emerging markets haven't had that same ability to mobilize fiscal resources to offset the damage done by a recession. But the upside of that is that because DM demand has held up, EM exports have held up relatively well. So emerging markets now are beginning to run very, very substantial external surpluses, current account and trade surpluses. So it's actually been, and this is kind of what's accounted for at least part of that huge dip and bounce that we've seen in emerging market currencies, because we've seen that they haven't been running huge deficits because their exports have held up well relative to their imports.
So that's a really interesting point, because we have seen a huge amount of sovereign debt uptake in Western countries. What about private debt uptake? What does the picture look like for emerging markets? How has debt grown domestically?
Well, no, private sector debt hasn't grown very much anywhere, because what do you do when you have a massive collapse in demand? You pull in your reins and you stop borrowing. And that's been as true in...
The reason I asked that, just to be clear, is because from what I understand, Turkey has deployed a bit of a different model. They've sort of pushed their domestic banks to lend, despite
they have.
Right. So,
and they're almost unique in that.
So that's a unique situation. Can you actually explain that for our listeners so they can understand? Because
Sure.
We're going to get into Turkey a bit later.
Yeah, Turkey's political priorities around growth are extreme. That, whereas most other countries, we find that there's a huge push for stability. The Turkish approach has been for several years, never mind the stability, just focus on growth. So while every other country was focusing their efforts, if they were at all, on the fiscal side, the Turks were pushing their growth impact through the banks, the state banks, especially into property companies. That's partly due to the political connections of the property sector in Turkey. But that's been a different model. And really, I don't think there's anywhere else which has had the same effort to push lending through the banks to support growth rather than direct government spending. The model in EM has always been either endure the recession or use direct government spending to support the economy.
Mm-hmm. All right, we'll return to Turkey a bit later. I want to bring it back to something you mentioned earlier, which is that you guys are macro-focused. And one of my questions is, when it comes to emerging markets, how much is it a macro picture, a tide that's lifting all boats, and how much of it is idiosyncratic, country by country?
In terms of asset prices, once you have a global trend, whether it's a big sell-off as it was in April, whether it's the big bounce back we saw in Q3, if it was, say the China-driven recovery of 2009, if it was the big sell-off that followed the taper tantrum in 2013, is that you do have countries that perform idiosyncratically, but that is really unusual. Most of what happens in emerging markets is driven by global developments, and it is not impossible, but it's very difficult for individual countries to swim against that tide. So the key thing to watch tends to be global developments, by which overwhelmingly we're talking about global growth as a driver of asset prices. And yes, you can get individual countries which outperform or underperform within that. But, the key piece of information is what's happening in the global economy. And that's why we sort of start off our investment process really by looking at the US, China, and Europe, rather than from the bottom up and going through all the individual markets and trying to figure out what's going on there.
Has correlation grown in the last few decades?
No, it's been fairly consistent all along. I mean, sort of the first thing that happened really when I started this job was the Asian crisis, which was a synchronized thing. And that's because, the global forces which drive EM are very similar across all emerging markets. That the Asian economies dug themselves into the same hole because they faced the same pressures. And, the way to think about emerging markets is kind of as the tail of the global economic dog, and you really have to have a feel for the global economy to invest in EM. It's no use thinking, if you've got a good feel, for example, the iron price and global liquidity, that'll serve you a lot better in analyzing Brazil than pretty much anything that's Brazil specific.
So what is the big story for emerging markets in 2021? And is there anything that other investors you think are missing?
Two different questions. Look, the big story is coronavirus, and there's absolutely no way of missing that. The consensus around it has become really quite optimistic in terms of that we're going to have a vaccine. That vaccine will be distributed fairly smoothly. That vaccine will work reasonably efficiently. And by the end of 2021, we should be in a world that looks pretty similar to where we were before this whole thing began. That's the core scenario. That should be positive for EM assets. We don't really see, if you look at current EM asset prices, if you look at stock prices, if you look at currency levels, that a full recovery is in the price. We're gearing ourselves to that. In terms of what investors are missing, it's quite tricky at the moment. I mean, clearly the job of being an active manager depends on picking up on stuff that other people are missing. I think it may be a little bit early to see which countries will do best and worst. A lot of it will have to do with enabling the banking systems to support growth. I think the other interesting question, though, is, what we referred to earlier in terms of the difference between EM and DM in terms of quantitative easing and the ability of governments to finance themselves. The squeeze is going to continue in the short term, and I think, we're going to have to see if countries like South Africa or Mexico or Indonesia will be able to deploy public sector balance sheets to support the economy. I think that's the interesting question. And obviously there are questions about the implementation of the vaccine and counter-virus efforts. But we've got good questions. I don't think we as a house necessarily have any really good answers yet.
Okay, super interesting. So a few questions. One is, why are there questions about whether or not QE can be conducted successfully in EM? And which countries do you think are better positioned to be able to do it effectively that might have the credibility? That's one question. And then I want to put a pin in a second question, which has to do with, how do you identify which countries have been most depressed by coronavirus? I imagine countries, for example, with large tourism sectors could benefit from a very quick rebound. And then I'll have a few more, but why don't we begin with QE and then we'll get into the specific things like service sector and also geopolitics, because you mentioned Biden, and that brings us into a conversation about Turkey.
Absolutely. I mean, I think if you kind of look at the way we used to think about economics and government financing, sort of, especially, say in the 90s before Japan embarked on its huge fiscal expansion, but also, until the global financial crisis, when we started to see QE in the UK and the US and belatedly in Europe, there was this assumption that if you had central bank financing of government deficits directly or indirectly, very quickly you'd end up in Weimar Germany with hyperinflation. That immediately it's currency debasement, or there's 100 other terms. And if you looked at emerging markets, that was particularly glaring, because emerging markets are the countries which, in, say, our working lifetimes, we have seen hyperinflation in a bunch of countries. We've seen it in South America, we've seen it in Bulgaria, we've seen it in Ukraine, we've seen not quite hyperinflation, but something pretty ugly in Russia. And that was, and those were all based around the same thing, which was government financing of central bank financing of government deficits. Also, if you look at Argentina, which I think is the one sort of reasonably large economy where you have had the central bank providing a lot of money to the government, they've consistently had high inflation, they've consistently had a foreign falling currency. So this presumption that QE or government finance or central bank financing of deficits was inflationary and was dangerous and destabilizing. Certainly that was orthodoxy in the developed world, but it was especially strong orthodoxy in the emerging world because that was people's lived experience. It wasn't just that, we had memories of the 1920s or whatever. It was, this is what had happened, in countries that we were looking at. And that's why you have this presumption. And to be clear, we haven't seen significant QE in a lot of emerging markets. What we've generally seen is that the commercial banks who would otherwise have been lending to the private sector have provided a lot more funding to the government. And to the extent that there has been extra government borrowing, that's been picked up by the banks. The assumption was always, the term to print money is problematic anyway. But if you say that when the central bank creates money, or the central bank enables commercial banks to create money, sort of pushing money through the system, that money is going to end up in dollars or euros. We're going to get a run in the currency, you're going to get inflation, and you're going to get the situation spiraling. Now, there are a couple of countries where we have seen big fiscal efforts, not quite on the scale of the US, but certainly up there, and those are South Africa and Brazil, which are two of the countries which you would have expected to be most vulnerable. And so far, those countries have held up reasonably well. We haven't seen QE, but we have seen a big fiscal expansion. It has been picked up by the banks rather than by the public sector. But, we have certainly passed the first test of looser monetary policy in EM. So I think that is relatively reassuring.
So I want to ask another question regarding QE, because to my mind, the issue isn't just fiscal responsibility. For some of these countries, there's a political dimension to it, which is that if you empower the government of a country which is perhaps not as stable, the institutions aren't as credible, don't have the same history as Western institutions, isn't there a danger that you might enable the rise of an authoritarian regime within a country that then has that level of control over the purse?
I'm not sure why that's especially an EM question. I mean, what we're seeing in the United States at the moment is exactly that.
So you think U.S. spending endangers?
No. I mean, I think the lack of discipline, enables authoritarian government. I don't think it's necessarily QE, which lies behind that.
I think, just to be clear, my point is, Argentina is a great example. Argentina has for years operated a patronage system. And isn't there a danger if you've got a, quote, immature, I don't mean that in a demeaning way, but a, quote, immature or historically irresponsible government that has a mandate to spend even more money, that money can easily be used to buy votes and buy political power. And, we've seen, for example, in Turkey, Erdogan uses interest rates in order to, he pushes the central bank to engage in lower interest rate policies in order to win elections.
Yeah, to win elections, but, also for the benefit of the property sector. I think whatever's driving authoritarianism in the world, it doesn't seem to be especially tightly related to government economic policy, to fiscal policy, or anything else. We'd seen the UK and the US slide towards exactly what you're describing in term, I mean, the UK, we've seen the allocation of various contracts suddenly become very untransparent. The Trump administration is kind of a byword for similar as well. Clearly there is a rise of authoritarian regimes or authoritarian tendencies, even in, well-established democracies, let alone emerging markets. And we've seen the same in Poland. We've seen the same in Brazil. Populism is by no means exclusive to the developed world, but it's much harder to trace that directly to the populist regimes. That we have seen populist regimes loosen policy a lot, but the authoritarian track does seem to be somewhat distinct from this path towards policy loosening.
I probably should have said corruption, because yes, there is the risk, of course, that a very adroit, charismatic leader can take the reins and use the purse to his or her advantage. But certainly corruption is par for the course if you don't have disciplined countries that engage in higher amounts of deficit spending and if sovereign debt markets allow it. I'm curious how you think that this recovery in emerging markets will compare to the one that followed the 2008-2009 period. Will it be similar, or will there be qualitative differences?
I think there will be qualitative differences because the 2009 recovery was very, very specific. You had a huge crash in the developed world, and the crash then in the developed world was much worse than in the emerging world because the problems in the banking sector, be it Citibank or Lehman Brothers or HBOS or RBS or whichever other, or the Euro crisis. Those were not echoed in emerging markets. Generally speaking, emerging markets actually had a pretty good 2008. While their exports were struggling because of the problems in the developed world, domestically the economies were reasonably strong. And then you added to that China pushed through, probably the biggest peacetime stimulus in history in any country, pushed up commodity prices a lot, but also pushed up demand for goods out of, a lot of the non-commodity exporters. So you've got a bunch of stuff that's very different that time. Then DM growth was weak and they couldn't absorb exports. Now DM growth is stronger than EM growth. Then, China pushed through a very big property and commodity oriented stimulus. China is stimulating again. It's less property driven. It's less commodity centric. And emerging markets, the emerging market private sectors this time out are pretty much as stymied as property sectors in the developed world. So there are quite big differences, and because of those differences, one wouldn't expect, for example, the recovery to be led by places like Brazil or South Africa, the big commodity exporters. We'd expect a very different distribution of the recovery.
So assuming that we get, a bunch of vaccines, they're very effective. I'm also actually curious to what degree or how many resources you guys allocate towards trying to make that determination, to determine whether, in fact, the medical interventions and vaccines that are in the pipeline are going to be effective, because that's so critical to your analysis. But let's say we return to normal. What will do well in that environment? What will drive the recovery this time? And what sectors in EM do you expect to outperform in this recovery?
Well, I mean, the footprint of the coronavirus-driven recession has been overwhelmingly in the service sector, right? Because
like tourist economies and
tourism, hospitality, transport, those have suffered. So airlines, for example, have cratered completely, especially low-end manufacturing or agriculture. People still need to eat. People still need clothes. They still need, other bits and pieces. So, one place you'd start looking is, well, what's the footprint of the recovery going to be? It's probably going to be less commodity-centric, more tourism-centric. So Thailand and Turkey would be two particularly obvious tourist destinations. So Mexico, I think, looks pretty good on a US recovery. Central Europe, Turkey, to a lesser extent Russia, look pretty good on a European recovery. So there's a geographical element to it as well. But, if we get a virus, it's going to be a vaccine, it's going to be the hardest hit sectors which recover most strongly. And that's really what we need to focus on.
So to that extent, there are countries, Greece foremost comes to mind, it's Turkey's neighbor, that have been depressed as a result of the fact that they have relied enormously on things like tourism and the service sector.
Yeah.
They're developed countries. They're not emerging markets. But does your firm ever consider investing in those countries because of the unique challenges, the unique reasons why we've seen a huge collapse in demand in 2020?
Not really. I mean, especially because our investment style is overwhelmingly about currencies. So specifically Greece, it's
I
in
see.
the Eurozone. There's a sovereign credit element. People who do EMD are interested in sovereign credit. But the Turkish sovereign credit really has relatively little to do with the economy and much more to do with continued support from the European core. I think there's plenty really going on within EM that, it's not like we've exhausted the opportunities in EM and we need to look elsewhere.
Right. So let's move to Turkey. I think we did a fantastic job of setting this all up. From what I've seen, this is the country that you seem to focus on most, and you've got a ton of Turkish followers on Twitter who really seem to appreciate your analysis. Do I have that right?
They don't seem to like the analysis always. It's been a big focus, not really because it stands out uniquely in terms of the investment, but it's one that people are exceptionally interested in because it's exceptionally volatile. You've got the scope for, there continues to be the possibility, I don't think it's likely, but there is the possibility of a major crash, a major crisis in Turkey. And I think that's why it tends to be a big focus of attention. Also, Turkey is hugely important geopolitically, borders with Russia, well, not border, but, overlapping zone of influence with Russia, support of Azerbaijan against Armenia, involvement in northern Iraq. There's somewhat obscure relations with ISIS. It's an interesting country, in 100 different ways. It's also a very high yielder. I mean, Turkish government bonds, yield in the teens now. It's a possible currency crisis. You have it's probably an exaggeration to call President Erdogan a dictator, but not a huge exaggeration, and that sort of political authoritarianism does lead to volatility. So there's a huge amount going on in Turkey. I mean, I think Turkey is very interesting because, like any country at the edge of a crisis, whatever happens, there'll be a big move. It's just if it slides into crisis, that move will be down. But, it's very, very cheap already, that you get, sort of 13, 14, 15% on Turkish government bonds. So there's a huge amount of money to be made if it doesn't crash.
Right, because your point being the yield is high, but it all depends on the annual devaluation of the currency in which the debt is denominated.
Exactly.
So the real yield could be negative, and has been for some time.
The return, it has been for some time, yes, and it's been even now, it's been one of the worst performing currencies in emerging markets. The lira is down over 20% this year, and that's really just Turkey and Argentina now. Okay, Russia's done badly, but most emerging markets have done much, much better this year than Turkey.
So I want to point listeners to two prior episodes that we've done dealing with Turkey. One exclusively on Turkey with Soner Çaptay. That was quite recently. And another episode that we did with Peter Zeihan. It was a 2-hour-long conversation. I think the stuff about Turkey may have been in the overtime, and it dealt mostly with the timely situation in the Eastern Mediterranean and the ongoing conflict there between France, Greece, Turkey, Libya, etc. So I highly recommend that because I absolutely agree with you, Paul, that there are many reasons outside of the economic picture why Turkey is so interesting. But walk me through the economic picture. Why is Turkey in such a vulnerable place, and how does the lira factor into this, and how do Turkey's political institutions play a role in its current economic situation?
I mean, the core of Turkey's problem is foreign debt. It's a country which did very well for a long time, but that did mean that, investment ran ahead of savings, so they had to import savings from abroad. They ran a current account deficit with foreign capital coming into the country, picked up a large amount of foreign debt, and I mean, there are various wrinkles that, a lot of the debt was lent on in dollars, so theoretically, It's not the banks which have the dollar exposure, it's the end borrowers. But, the point you get that tends to happen when you have a lot of foreign debt is that when the lira devalues or the currency devalues, the cost of servicing the debt goes up because you need more liras to buy a dollar or a euro or whatever you need to service your debt. So you've got this vulnerability from having a lot of foreign debt, and once activity slows down, the temptation is for the government to try and push more activity through the economy to push lending up. Then some of that lending spills over into currency weakness and you're at risk of a cycle or a spiral. Now, the trouble is that in the most recent round of problems, the Turks have tried to support the lira not by keeping money tight and kind of squeezing domestic liquidity to keep the lira strong, but by directly intervening, and thus widening the negative net foreign asset position, which actually makes the country more and more vulnerable. And it was the finance minister, Mr. Al-Bayrak, who had been kind of the voice of this policy, and it just became insustainable because there was more money onshore looking to get into dollars than there was money coming in to provide that dollar liquidity. And that's really the scene setting here. You've got a lot else going on. The AKP, the Islamist party, which holds the presidency, which holds a majority in the parliament, has really a lock on political life. They're very tightly tied in with property developers, which means that economic policy has lent to low interest rates, loose money, and that has worsened the problems of the economy. So really, the situation we've been in, we had a dress rehearsal in 2018, they stabilized the economy, then immediately took their foot off the brake and things started to slide out of control again. This got much worse because obviously it's a very tourism intensive economy, somewhere around, a huge level of employment, a huge amount of activity is based on tourism. So if you have a 90% plus fall in tourist numbers, and it was all but 100% in Turkey, that's a major economic blow. And the government didn't have a good way of responding to that. I mean, what they now appear to finally doing is that the government kind of gets the monetary religion, has tightened monetary really quite violently, and the recent central bank rate hike was really just recognizing a tightening which was already largely reflected in prices onshore. I mean, what happens now is, they don't have a very wide window. They don't have a lot of slack in the system. They've got very little in the way of foreign exchange reserves to make it easier for local agents trying to pay foreign debt to buy dollars. They have to get things exactly right. They have to endure what will be quite a severe recession without politically destabilizing the situation. Tight money means just that. It means lending drops. That's going to be bad for asset prices. It's going to be bad for politically connected people. But I think what has changed is that now there is a political recognition that the choices are between pain and more pain, that there isn't a soft option where they support the lira out of foreign exchange reserves and hope to muddle their way through. I think, I don't know if it'll last, but at the moment, everybody, both in the presidency, in the central bank, in the finance ministry, has got the message that they either have a crash or the people of Turkey endure a lot of pain in the short term. But the question is really, is the pain now or is the pain later? And that's what they now finally seem to be appreciating.
Yeah, the point about the currency decline in the face of the coronavirus pandemic, which depressed their tourist industry, was kind of like a double whammy, because normally if you do have a drop in the value of your currency and you are a tourist country, that can actually be very beneficial so long as you are perceived to be stable and politically stable and people don't fear for their lives.
It's less that, it's more if you don't have too much debt, because it's like everything else in finance. If you have a lot of debt, you have a lot of vulnerabilities, and you don't have that margin for error, you don't have that wiggle room. If things don't go right, that's always difficult. But if things don't go right and you have a lot of debt, then the consequences can be absolutely terrible.
What are you looking for to see if they really have gotten religion, as I think you put it?
I think the key is the credit numbers from here. What happens to bank lending? It's got to come down.
Mm-hmm. But so here we get into the really interesting stuff, the stuff that interests me. If bank lending comes down, that's going to create some political problems for Erdogan, right?
Yes,
so
absolutely.
He's kind of stuck between a rock and a hard place, which is that he needs lending to be up. in order to benefit him politically, but at the same time, he needs the lira to be stable for the same exact reason.
Yeah, but it's squaring the circle. You can have one or the other at the moment, with no foreign exchange reserves, with no activity likely to generate those, foreign revenue, no services exports, no tourism revenue, not much in the way of remittances from abroad. They have to import less, in short. And the only way that's going to happen is by clamping down on domestic demand, which has to come through the banking sector. So you can support activity or you can support the lira. There's literally no situation in which you can do both.
So let's talk a little bit about the geopolitical and political risks that I was hinting at those a second ago. How do you think about those factors in calculating your decision to invest and how much to invest in Turkey?
I think in Turkey, it's really about direction, because this is the thing. It's not like other countries where you kind of have a spectrum of opinion, not a spectrum of outcomes. So if you look at Mexico, you could have deep recession, you could have mild recession, you could have slow recovery, you could have fast recovery, and you look at that. In Turkey, really, there's only two paths. There's absolute crash, or there's grit your teeth, the lira's already cheap, so you see maybe a slow appreciation of the currency and you clip your coupon, or you get an absolute crash. There really isn't even a third, let alone a further option for Turkey. So all we're really trying to do is assess the probability that you go one way as opposed to the other.
So when it comes to NATO and diplomacy, the last 4 years have been somewhat of a shit show?
I think that's fair, yes.
It's been a bit confusing what U.S. policy is in the region. Of course, the United States has been generally, I think, withdrawing from the world or consolidating maybe in a controlled way, a kind of controlled deleveraging of American power. But the way in which that process has unfolded in the last 4 years in northern Syria, as well as in the Eastern Mediterranean, with America's role there in helping to counterbalance and act as a partner in negotiations between the EU and Turkey and between NATO and its members, has been a bit confusing. How is a new Biden administration going to change that? And what is that going to mean for Turkey and for its neighbors?
I think, the most likely outcome, again, is that it's a stabilizing factor because, Turkey, whatever you think of the Erdogan regime, whatever you think of the new Ottoman Empire or whatever the delusion of the week
Osman's
is.
dream.
Yeah. I mean, whatever you think of this, it is strategically irreplaceable. It's a bridge from Europe into the Middle East. It's a bridge onto the Black Sea. They control the Bosphorus. It's
to be clear, Turkey
critical.
is irreplaceable, is your point. Turkey is a geostrategic.
Yeah, sorry, what did I say?
No, you didn't. I just wanted, for listeners who may not have made that connection, Turkey is geopolitically
It's an irreplaceable member of NATO. They were the NATO member which had a border with the Soviet Union back in the day. They're culturally have been regarded as a bridge between East and West. I don't know if we really want to get into the nuts and bolts of what constitutes the West. And so in the past, the NATO has and successive American administrations have taken the view that they can put up with pretty much anything, as long as you have things like the Incirlik air base, as long as, NATO facilities are on Turkish soil, that, it doesn't matter in terms of the human rights abuses, it doesn't matter the various forms of adventure in northern Iraq or Azerbaijan, they've sucked that up. Now, it's never been entirely clear what the Trump administration was trying to achieve. So it seemed to be a balance between Trump Hotel in Istanbul or just this general withdrawing from the world, which was the driver of the Trump administration outlook on the rest of the world. I think, as long as Biden is seen, and I think that makes a lot of sense, as the continuity president, looking back to, what we had to a greater or lesser extent, under Republican or Democratic administrations up to 2016, you would expect the same, that there is a limit. I think especially the Turkish adventures in northern Iraq would be regarded as highly troubling by the Western administrations. But, the West doesn't really have much of an alternative. You kind of have Turkey inside the tent or you have Turkey outside the tent, and Turkey outside the tent isn't obviously less of a problem than Turkey in the tent. I mean, Turkey in 2001 saw an absolutely unprecedented rescue effort because they came off the currency peg that they had, with a vast amount of foreign debt. They had the biggest IMF program ever in terms of relative to a country's quota. The rescue effort back then was unprecedented. I think it's highly unlikely that Turkey would ever benefit from that sort of coordinated effort, that that Turkey just could not be left outside the tent, because we were going into we were looking back at the Gulf War, we were looking at various other things. I think Turkey would struggle a lot more to get a Western rescue package now. We saw disagreements about the Turks essentially using refugees from Syria as a political lever against the European Union. But, relationships have deteriorated to the point that if what you're interested in is the ability to produce, a rescue package for Turkey, I think the probability is much lower. But on the other hand, the willingness to push Turkey off a cliff is also much lower, just because, it's very hard to replace Turkey within the Western alliance.
So to that effect, what's the likelihood that a Biden administration might end up slapping sanctions on Turkey? What's the risk of that for investors?
I think it's a risk, but I think, like I said, I think it's not a high probability because, the Turks are unlikely to bend. So the chances are you just worsen the problem, because like releasing refugees into Europe was a highly risky, thing. But this is what we keep seeing about populists. They will do an awful lot more. That they were always willing to go further and do things that nobody thought that they would be prepared to do.
I would say, particularly certain types, the kind of strongman personality type, which is very popular. As you said, it's also popular here, not to get too politically, but I was watching a press conference of one of our governors here in the United States, and I just couldn't feel like he was actually a more adept populist, strongman, sort of mansplainer than anyone else who's inhabited the White House recently. A last question for you, Paul, and that has to do with the lira.
Yep.
Do you see the lira as a buy at these levels?
I do, with qualifications. I mean, we run larger funds and smaller funds. We run higher risk and lower risk funds. So for a small, relatively risk-seeking fund, I think it makes a lot of sense. There is a scenario where things go disastrously wrong. You want to be able to stop your losses. So if you set a maximum stop loss, say 7, 8, 9%, you've got to go into Turkey conscious that this is something that could go disastrously wrong. But I think, a tourism, Eurocentric service economy is probably a pretty good place to invest right now. There is an appreciation by the policymakers that they have this chance to do the right thing. I think that the balance of probability is that we end up in that beneficial scenario where things go right and you make a lot of money. But, that's a balance of probabilities. There is a scenario where things go disastrously wrong. It's not a place to put in a position so big that you can't get out of it.
Well, on that note, Paul, I really appreciate you coming on. It was fascinating. It was also a very condensed conversation, which I actually enjoyed.
Thanks very much. Really enjoyed it. Always happy to speak.
Thank you, Paul. And as I mentioned, for Hidden Forces Premium subscribers, there's no overtime this week, but there is an afterthought segment that I'm about to record right now, and which will be available on the overtime feed. And there is a transcript and rundown to today's conversation as well, and you can find all of that on patreon.com. or on our website on the episode page for this week's episode at hiddenforces.io. Have a great week, everybody. Today's episode of Hidden Forces was recorded in New York City. For more information about this week's episode, or if you want easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you want access to overtime segments, episode transcripts, and show rundowns full of links and detailed information related to each and every episode, check out our premium subscription, available through the Hidden Forces website or through our Patreon page at patreon.com/Hidden Forces. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. Join the conversation at Facebook, Twitter, and Instagram at Hidden Forces Pod, or send me an email at dk@hiddenforces.io. As always, thanks for listening. We'll see you next week.